Hello, income harvesters. Welcome back to the Harvesting Income channel. And if you're new to this channel, welcome. And for all of you, wish you a happy new year once again. Today, I'm going to talk about a new fund that is ISPY. I mean, what is so unique about this? This is another income fund. So that's what you might be thinking. But this is an ETF that provides high income and it uses the zero DTE strategy, but it provides little higher return compared to other covered call funds. Like there is something which is different or kind of a twist here. Okay, in this video, I'm not in the camera because I wanted to focus on the details of the fund. Uh, I will take you through the information and tell you how it works and explain to you what are the different pros and cons. Uh, I hope this will be pretty useful if you watch and stay till the end. And if any of you have, purchased or invested in this fund, feel free to share your thoughts or comments. Okay, so the fund we are talking about is ISPY. Let's get into this one. This is from Proshares, and it's called the S&P 500 High Income ETF. So, what is the basic, mandate of the fund? Like, there are two things that we can quickly find here from the name itself. We know that it's based on the S&P 500 index. That's point number one. And the fund is actually using daily options. You can see on the screen on the left bottom, on the left side bottom, you can see that the fund targets high income. Basically, it uses daily options and a covered call strategy based on that, which means the fund is actually using the zero DTE covered call strategy to generate that high income. So yeah, there are a lot of other top performing zero DTE funds like the XDTE, QDTE from Roundhill funds. So this is nothing new or nothing completely out of the box. But when you look at the thing that they're saying here, like uh, the fund actually captures the S&P 500 returns. That's fine. On the right side, you can see they are talking about the differentiated approach. Uh, we have to observe and see whether this differentiated approach is going to work in the future and how many years it's going to perform well. That is something to be seen. But what they're saying here, let us look at that. Unlike traditional covered call ETFs, which sacrifice upside for yield, iSpy targets both short-term high income and attractive long-term return potential. So essentially, what they are saying is this fund can actually provide you the capital appreciation potential, not just the high income. A lot of high income funds, provide you that income, but the value of the funds gradually erodes. Like, even if you look at the roundhill funds, they have seen some erosion in the value. Of course, they have the capability to, recover that value also over time. But the question always remains that how can we, reduce or minimize this value erosion? I mean, value erosion is not a bad thing because you are still getting your distributions. That's why the value is eroding. So you can't have the cake and eat it too, right? So yeah, in a way, that's what it is. But at the same time, investors want to have the principal amount intact, the amount that they invested, or the value of the fund to remain more or less stable. That's one of the concerns that everybody has. So this fund is kind of trying to understand that problem and trying to give you a solution to that problem. And again, quick word of caution here, disclaimer, this is not investment or financial advice. You have to do your own research, and this is not a recommendation to invest or buy this fund. Okay, with that said, let's look at the basic details of the fund. Let me zoom in the screen a little bit so you can see it. The ticker symbol is ISPY. The expense ratio is 0.56. I find it very reasonable. Not that high, not that low. Some of the covered call funds have like close to 1%, especially the ones with zero DT covered call strategy. And yeah, it's basically following the 505 companies of the S&P 500. And yeah, uh, pretty decent fund. And you have the price at $46. Yeah, so these are the basic information about the fund that we have in front of us. But let's look at the performance. Like I did the analysis of the distribution plus the capital appreciation part. Like I'm not relying on the numbers that's mentioned here. Let's look at the details. The fund was launched back in December 2023, so it has about 2 years of history that we can go by. So it's not a completely new fund. It has a track record. Let me quickly go back to my Excel sheet. I am doing the analysis just for 1 year. So, bear that in mind. If you want to do further, deep dive, you can look into it for 2 years and see where it goes. Let me, increase the size of the fonts or the zoom in a little bit so you can see clearly. Okay, long story short, let's look at the price first. The recent price is $46.10. This is as of January 6th. So I've taken the closing price of January 6th for this example. And 1 year ago, the price was 44.42 cents. So clearly, there is a capital appreciation component here. So, when you do the math, you can see that the price appreciated by about 3.78%. Pretty decent, not something great, but it's still okay. What we are trying to look at, or what I'm looking at personally, is sometimes some kind of a stable net asset value or price, or a moderate or low return is fine for me. But uh, I would like to see that there's no NAV erosion in this fund because that's what they're saying in the objective. Now let's look at the dividend yield part of it. Uh, so I'm getting a 8.79. So how did I do this? I looked at the 2025 distribution. So when I add up all the distribution of the calendar year 2025, January to December, January to all the way to December, it's about $3.91. So based on that, $3.91. Imagine you invested 1 year ago. The dividend yield you're getting is about 8.79%. So 8.8% and 3.8% roughly is the you know dividend and price return respectively. So total return is close to 12.6%, which is pretty decent and you know reasonable. Yes, the dividend yield is not super attractive, but you're able to capture that price return as well. So if you're someone who's looking for a balance between the two, this is a great option. I think this would be slightly lower compared to some of the other high yield funds, but still it's not that bad. You're still getting double digit returns. Now, what is it that makes this fund unique, according to the claims of the fund house? I'll explain that now. Uh, this is not my view, but this is the information that is provided by the fund. I'll quickly show you this document. So this is the document which I'll have put a link to the document in the description below. You can access this on the Proshares website. And here it says, should you expect more from your covered call strategy? You can find it in the website also. Like if you go to the fund page on the Proshares website, and if you go to the investment case, you can find it here, fact sheet or investment case. And I also put a link below if you really want to read that or download that for your reference. Uh, so target high income with greater total return potential. So this is essentially what the fund is trying to achieve. So a quick read of this, you can understand that in recent years, covered call strategies have become a popular part of investors' toolkits, particularly those seeking high levels of yield. While covered call strategies can generate attractive levels of income under the right circumstances, traditional strategies typically require investors to make a costly trade-off between high income potential and potential for total returns. Basically, they're saying that you have a trade-off between the high income and the high capital appreciation, and that actually reduces the total returns when you have the high income. A recent innovation in the options market using daily options provides a solution. And they say that Proshares is the first to use this approach, create the opportunity for investors to both target high income and participate in the equity market performance over the long term, eventually capturing returns that traditional strategies sacrifice. So this is what they are saying in the introduction. And there's a huge research and thesis that they have put across. Like they have put a case study on this. You can go through this case study. We are aware of this. The court call, funds sacrifice the upside. Uh, but I'll show you the solution part or the post solution that they are showing you. And yeah, this is what they are essentially saying that they can achieve better results compared to the other covered call funds. So S&P 500 covered call strategy powered by daily options. So they've compared three different data points by backtesting the historical data. So one is the S&P 500 index, the first column. That is showing you about 31.38%. Let me zoom it further for you so you can see it. So they have compared the returns of traditional S&P 500 index and a daily covered call index and the traditional covered call index. And this is a great, uh, example of, how different strategies perform. So S&P 500 index gave you about 31.38%, whereas S&P 500 daily covered call index delivered about 28.24%, and the traditional covered call index gave about 20.21%. So basically, what they are saying is the third one, the traditional covered call index, is actually providing a low amount of returns, and it has a huge gap when it comes to comparing the return with the benchmark. It is lagging behind the benchmark by about 11% roughly. So that's the reason why they are saying, the daily covered call index or the daily covered call strategy can improve the returns and bridge the gap. Uh, I would like to point out here that even though ProShares says that they are the first one to do this, technically they are not the first one. Roundhill and other funds have also done the daily covered call strategy and even Defiance and Yield Max too. So I'm not sure if that claim is correct. But one thing I can say is ProShares has one unique um, uh, aspect to the strategy, which I will explain later. So stay tuned, till the end so you can get the full information. So here you look at the returns, like I think they have taken December 18, 2023 to December 31, 2024. So roughly they have taken 1 year, data, and they've taken this information, based on the past data. Anyway, long story short, what they're trying to say is that traditional covered call funds are actually lagging behind the index, which we all know, like it's not going to outperform the index. There will be a gap in the performance, and as long as we are getting like decent amount of returns, it should be fine. But if you are able to get higher amount of returns using the daily covered call option, then why not opt for that daily covered call strategy? That's the question, million-dollar question that ProShares is using as a unique selling point to attract investors. My view, I completely agree with that. Yes, that's something that needs to be seen. But when I look at the returns last year, 2025, it seems to be decent. Like I have not compared with the S&P index, but it seems to be pretty decent, and I don't see any issue. Let me quickly compare, S&P 500 and this one, the ISPY, so that you can get a clear view where it stands. So let me go to the dividend channel and I look at the quick overview of the returns. So I compare it with the S&P 500. Okay, so here you go. Yeah, pretty decently. When you look at the ISPY and SPY, there is a 4% gap. So let me zoom it for you. So on the top, you can see 15139 is uh, the index S&P, and 14094 is the ISPY, which is the value of the $10,000 you invest. So if you start with $10,000 and you put it in the S&P 500, you get 15139. You put it in ISPY, you get 14094. So let me highlight this. Average annual return is about 18.2% in ISPY and 22.4% in SPY. So basically like 4% something difference. Even this is with dividends reinvested, even with dividends not reinvested, like without dividends reinvested, if you look at it, um, iSpy is lagging behind, like it's about 16.5%, whereas SPY is 22.2%, like it's a higher difference. That's what we can see in 2023 to 2026. This is the performance. Let me compare another fund just to see if there is a difference. Let me use the Neos Pi, which is also known to give decent capital appreciation. Yeah, when I compare it with Neos fund, there's not much of a difference because Neos also uses additional strategies to enhance the upside. So yeah, this is a fair comparison, and you can see both are neck to neck. And yeah, in some periods you can see iSpy is outperforming, but it's pretty close, like not so much of a difference here. Very close. Let me compare it with XDT. Okay, yeah, not much of a difference again. So long story short, what we see here is like whenever we have the daily covered call strategies, those funds are performing well. Whereas if you go to the traditional ones like the XYLD, XYLG, and so on, I'm not doing the comparison here, but I'm just telling you it will be lower amount of total returns because you might receive a higher amount of dividends, but you are going to see a moderation of the capital appreciation. Thereby, your total returns is also going to get affected and it's going to underperform the overall index. So that's the long story short we are trying to say here. But what I find unique here is the fund actually, instead of, we see that all these, uh, zero DTE funds provide you weekly distributions, right? But when I looked at this one, they provide a monthly distribution. Like that's another unique thing I observed. Even though weekly or monthly doesn't matter. For me personally, it's not a major decision factor. Like I pick some funds, some weekly funds because I like the dividend flows, and sometimes I pick the monthly ones. If the performance is good and the NAV is stable. But I would not declare a weekly fund better than the monthly one because that's not the way to analyze the performance. When I look at this one, like they pay monthly, and the good news is they're also doing uh, daily covered calls. Daily covered calls means daily income generation. Zero DT calls are written and premium is earned every day, and the distribution happens every month. So the fund is actually trying to play a differentiated game here. Now we have three different funds. We have the XTTE. Okay, let me go to the top here. We have this fund, ISPY Proshares. We also have STE and STTY from Defiance. So many players in the market. So they are trying to differentiate in two ways. One is to uh, have a traditional covered call strategy with the zero DTE option and enhance the returns and total returns and also give a decent high amount of income, maintain the NAV or the price, and also provide monthly distribution so that you don't have this huge NAV erosion problem that we see with other funds like for example the Defiance funds or some of the Roundhill funds, some of the Yield Max funds have this. NAV erosion problem. So they try to tweak the strategy in a nice, intelligent way to be able to provide that high targeted income, decent capital appreciation. So thereby they have this unique differentiated approach, and they also try to curtail the distribution to monthly. So they have a visibility on how much they can pay, rather than trying to pay every penny and every cent earned, from the premium income. They can look at the month performance and then they can pay accordingly. That way, the fund is more stable and more structured in terms of maintaining the net asset value. So I feel this is a great example of a fund which can give you decent protection from NAV erosion. At the same time, it can give you a decent amount of yield, not a super high yield, but a decent amount of yield, considering that it's an index option ETF. So I hope you like this video. If you want to see more of these kind of videos, please share in your comments which fund you like me to cover or which ETF you want me to cover. And I will see you once again in the next video. Have a great day. Happy investing. Thank you.